everybody, and welcome to Beyond Death and Taxes, the podcast where we unpack the only two certainties in life, and we try to make one a whole lot easier to deal with. We're your hosts. I'm Clay. And I'm Matt, and we're part of the team here at Avalara. Every episode, we'll bring you insights on tax trends, regulatory shifts, and automation strategies that are shaping modern finance teams today.
Because while death may be inevitable, taxes as well. At Avalara, we're doing everything we can to ease the burden of tax compliance.
Happy New Year and welcome back to a brand new season of Beyond Death and Taxes, the podcast where finance leaders get clarity, context, and a little bit of catharsis when it comes to tax compliance.
I'm Clay.
And I'm Matt, and we're kicking off 2026 with a big one.
That's right, my friend. So for the first episode of the year, we are bringing you highlights from Avalara's flagship annual event, the one everyone in the tax world waits for, our 10th edition of the Avalara Tax Changes webinar.
10 years running, and this year's update may be the most important yet. From sales tax changes and sourcing complexities to digital tax expansion and tariffs, 2025 was packed with developments, and 2026 is already shaping up to be even more active.
This webinar featured insights from a powerhouse panel, Gail Cole, Scott Peterson, Argi O'Leary, and Craig Reed, who covered everything from new state-level tax policy shifts to cross-border trade challenges and emerging enforcement tactics you'll want to hear about.
And in true Avalara fashion, this conversation didn't just focus on what's happening, but why it matters and what your team should be thinking about next.
Before we dive in, it's time to make our first stop of 2026, back down to the compliance graveyard, where we lay to rest outdated ideas that no longer serve modern finance teams.
And today, we're officially burying the belief that tariffs and trade compliance don't apply to you.
For years, plenty of companies figured, we're not a global brand. We don't import. That's somebody else's job. But in 2026, that thinking fast-tracked to risk and revenue leakage.
That's right. And with an end to de minimis, expanded tariff rules, and new reporting requirements around the country of origin, cross-border compliance is no longer just for enterprise giants.
So whether you're selling goods internationally or just sourcing parts or materials, you are in the game now.
Rest in peace, not my problem. Tariffs are everyone's problem now, Clay.
All right, graveyard cleared. Now, let's get into updates that really matter as we step into 2026.
You'll hear highlights from our 10th annual Avalara Tax Changes webinar featuring insights from Gail Cole, Scott Peterson, Argi O'Leary, and Craig Reed.
This episode covers new sales tax laws and state-level enforcement shifts, the growing taxation of digital services, the rise of retail delivery fees, and how trade and tariff policy changes are reshaping global operations.
That's right, Clay. Let's get right into it.
Thank you for joining us. So I started researching and writing about sales tax policy changes when I joined Avalara in 2012. And for the past 10 years, I've compiled the year's key tax policy developments into our annual tax changes report. This is our 10th edition. And I've done so with the help of an incredible team of writers, designers, editors, and subject matter experts like the powerhouse panel here with me today, Scott Peterson, Argi O'Leary, and Craig Reed. So, Scott, I'll let you introduce yourself.
Thank you, Gail. Welcome, everybody. It's nice to have, and as Gail said, she's been writing these things for 10 years, and I've been giving these presentations on what she writes for 10 years. So it's a wonderful partnership. Thank you all for joining us today. What's going on in tax today is frankly almost overwhelming. 2025 has been a remarkably busy year in sales tax, and I'm gonna let Craig wow you with what's been going on in tariff, but you all know this is the world-class year in tariff changes. Thank you. I'm the Vice President of Government Relations for Avalara. Been here 13 years. I've been having a grand time talking to people about how taxes apply to their business and to their clients. Argi?
Thanks, Scott. Thanks for having me, too, as the Ryan outsider here. So I'm Argi O'Leary. I'm a principal in Ryan's advocacy practice. I've been with Ryan for just shy of 4 years. And before that, I was a deputy commissioner with New York State Tax and Finance for almost a decade. So lots of experience in tax administration as well now on the consulting side. And I'll pass to Craig.
Thanks, everyone. It's fun to kind of combine efforts here with Trade and Tariff Tuesdays with the Tax Changes report. So I'm happy to be on with everyone here. You can see from my picture, I'm a little bit more gray. I think that might have started in February this year when all the tariff changes took place. But it's been a heck of a year in the cross-border space. So we'll take you through a little bit of that today, and you're always welcome to join our Trade and Tariff Tuesdays every second Tuesday and get more information. But look forward to talking a bit of cross-border and just finding out what's going on in the world of tax. So I'll let you guys take it away.
It's me. So the presentation, we have a lot to cover in the next hour, starting with a brief overview of the state of the states. Then we'll talk about which states are broadening their sales tax base, new and ongoing sales tax trends, enforcement issues to watch out for, and upcoming tax amnesty programs. And then last but certainly not least, trade and tariff developments, which have kept us on the edge of our seats all year.
So let's move on to the next one here. Let's talk about the state of the states.
Great. So states, in the last year about, or actually, no, Scott, this is you. You go ahead. Kick us off. Sorry.
Thank you very much, Gail. We're good.
Economy today, you all know this, but the United States isn't a single economy. No state is a single economy. Every state has multiple economies. There's almost nothing related from the north, from the Oregon border in California to the Mexican border in California. Those two economies are the two ends of that state there's like 15 different economies inside of California. There's 3 or 4 economies in Washington. Washington, D.C. is probably the only one that has one economy, and it doesn't have one economy. So if you have a city itself that's 100% government that doesn't have one economy, you can't imagine that the rest of the country is an entire economy. It is little tiny economies that make up this whole. And often they are completely different from each other, and they react to changes differently than each other. I'm from South Dakota originally. South Dakota's economy consisted of 2 things, just 2, tourism and agriculture. One might be doing great and the other is not doing so well. If it doesn't rain in western South Dakota, there's no corn and there's no wheat and no soybeans. Those farmers are in trouble. Same thing if the price of gas went up to $4 a gallon in South Dakota, there'd be no tourists. So we look at this from not the national economy, but from the perspective of each individual state. Now, this particular slide comes to us from an economist at Moody's who looks at what each state's economy is doing. And, it's his view that a good share of the economy, a good share of the United States is already in a recession, which honestly, there's probably one state in a recession any given time, any given year. 12 states are just barely getting by, and 22 states, no, I got that backwards. 16 states are growing, and you can see them in the blue. 12 states are treading water, they're in the orange, and then the 22 states that are in red are the ones that are struggling. And we know this. We hear about, the Iowa's economy going in the tank because nobody's buying soybeans. We know something's going on in Washington's economy because they're constantly raising taxes. Oregon's economy is economy of 2, if it's not 5. So every one of these people have a different reason to be where they are today, but there aren't that many that are really doing well. And it's kind of odd. Texas and Illinois both doing well. Normally Texas and Illinois do not align. They're not in sync because their economies are radically different from each other. And Florida and Texas maybe more so. This year, we're seeing really odd outcomes around United States, and that's going to continue. What's going to make it even worse is that the federal budget is going to have to change a lot in the next few years to account for the lack of tax receipts and the continuation of excess spending. We are no closer to a balanced budget today than we've ever been. And in many ways, it's getting worse. That can't continue. Keep saying this every year. That can't continue. Well, I'm going to say it again. It can't continue. So next year, somebody's going to have to make some efforts to do something to lower how much money we spend and to increase how much money we bring in revenues. These things just are not sustainable. What's really going to harm states this year in 2026 is the changes the federal government made to Medicaid. Medicaid is a dual funded program, partially funded by the states, mostly funded by the federal government. The federal government has reduced the amount it's going to spend on Medicaid. And the same thing with SNAP. SNAP has always been 100% federally funded, although it's 100% state operated. Starting next year, there's going to be a sharing of the cost and a greater attention on how states administer it by the federal government. And there's going to be penalties that are associated with failure they call it fraud, and it may be fraud, and it may just simply be errors. But there's an error rate out there that exists in the way SNAP funding is, how SNAP money is used. On top of that, you have a requirement in the SNAP funding that states, not a requirement, it's an opportunity. So there's an opportunity in SNAP funding that states can get more SNAP money from the federal government if they limit what a person can purchase with SNAP. And we're starting to see that. I read an article yesterday where 18 states have already had their waivers approved by the federal government. And waivers, in this case here, have the effect of reducing the sugar content food that person can buy with SNAP. Everybody's complained that you shouldn't buy heavy sugar stuff in the first place, and you shouldn't buy it with federal tax dollars. So we're starting to see that. So we have all those things that are going along, plus the fact that the federal tax changed, thereby reducing, and Argi's the expert on this, I can't remember if they reduced federal taxable income or federal adjusted gross income. But every state that has an income tax, and that's 40, have an obligation to look at their own income tax to see how the federal changes roll down through their tax. Every state except for 2 starts off with their income tax starts off with a federal number. It's either the federal adjusted gross income or it's a federal tax income. So in every situation, a state's tax is a function of what the federal government does to its tax. And they made some pretty significant changes to their tax this year. And all those are rolling down to the states. And we're starting to see states do odd things. They do normal things. They are changing their tax so that there is an accommodation for what the federal government did. And it's not a Republican versus Democrat thing. I've seen both Republican states and Democrat states have accepted the changes made by the federal government to their tax structure. And I've seen both Republican states and Democrat states reject them. So what the effect is, as you can see here in like Colorado, these are making the budgeting process more complicated because what they're coming in for income taxes is going to change if they don't do something. What they're getting in the way of SNAP benefits is going down. They're going to have to do something. And they now have to come up with more money for Medicaid if they want to participate in Medicaid to the extent that they have in the past. So we believe this is going to lead to rather significant tax changes inside state governments and that are unrelated to, even the ones that are unrelated to the federal income tax changes. Then on top of that, you throw in all the states that want to get rid of their property tax. Florida, Texas, Nebraska, Wyoming, all these states, frankly, almost every state has a problem with the property taxes, at least a public perception problem with the property taxes, and they all want to do something about it. And some of them have rather grandiose ideas of what can be accomplished. The governor of Florida is convinced that he can simply do away with their property tax. Politicians in Texas kind of have some of the same view, although they are starting now to figure out that that's an awful lot of money to try to come up with. We are going to see a lot of changes in 2026 because of all the factors that are impacting state spending and state taxes. And that's assuming that the economy stays the way the economy is today. the economy gets better, then things get better. Economy doesn't get better. And as we saw today in today's job report, unemployment has now gone up to 4.6%, the highest has been since 2021. I think some would argue that the economy is not trending in a way that would make balancing a budget simpler.
So I will say that with all of the increased need for revenue and states looking to get rid of certain aspects of their tax base, a lot of states or a growing number of states are looking to expand their tax base. We saw at least 9 states do that in 2025, including Louisiana, which began taxing digital products on January 1st, North Carolina, which started taxing rideshare services on July 1st, and Rhode Island, which started taxing short-term parking on October 1st. We know also that there are a number of states that are looking to expand their tax base in 2026. Argi, what can you tell us about that?
I think, Gail, you and Scott have already hit on this. States are looking to expand their base, and mainly because there's interest from legislators around the country in reducing or eliminating income and property taxes. And that has become very competitive among the states. They're kind of racing against each other to be able to say, we've eliminated income taxes or we're lowering property taxes. And there are a lot of lawmakers who are legitimately concerned about people, particularly seniors, being priced out of their homes through ever increasing property taxes. But there's also a recognition that any effort to adjust income or property taxes requires some other revenue source or a decision not to deliver the same level of service. Scott also hinted at that. So legislators are looking to the digital economy. And the digital economy has grown tremendously since the 90s when the internet was introduced. And now, in many respects, when we're looking at AI, cloud computing, blockchain, all of those new technologies, the digital economy has become the economy. So it's not surprising that governments are attempting to tax what's happening digitally in our economy. And unfortunately, what that means from a tax policy perspective is that more states are taxing what are called B2B transactions. So those are transactions between businesses, and much of the digital economy takes place in transactions between businesses and can lead to what's called tax pyramiding or imposing multiple layers of taxation on products and services that are already subject to sales tax. And these layers of taxation can increase the input costs that are borne by businesses and also contribute to inflation in the prices that are paid by the ultimate consumers. And a couple of states have really blown this up this year. So Maryland, Washington, and Texas have recently enacted or expanded taxes on the digital economy. So first, looking at Maryland, Maryland this year enacted its tech tax, and they did that in part to help close a huge $3 billion budget hole. So effective July 1st, Maryland's law is House Bill 352. It imposes a 3% tax on data, information technology services, software, publishing services, and licensing of media or software rights or other intellectual property. And the original bill in Maryland was intended to apply to all services broadly. So this was actually a scaled down version of the bill that actually passed that targeted technology in this tech tax. And the tax, as it's designed, applies to businesses within certain defined NAICS codes. So Sector 518 is computing infrastructure, 519 is web search portals, 5132 is software publishing services, and then 5415 is for computer systems design and related services. So those are the services that Maryland is pulling within this 3% tax. And they only created exemptions for sales of cloud computing that were made to qualified cybersecurity businesses, and also sales within what's called the University of Maryland Discovery District. So it was very limited exemptions, as the tax was intended to apply very broadly. Another piece of the legislation repealed Maryland's sales tax exemption for custom software, regardless of how that software is transferred. And I guess on the bright side, Maryland's law does include a process for businesses that are subject to the tax to request what's called a multiple points of use, or MPU certificate. Maryland's process, I'll say, is clunky, but the inclusion of the MPU process is an acknowledgement by Maryland that there are challenges for businesses in accurately calculating this tax. It's particularly true when we're looking at digital products and services that are used delivered electronically and could be used in multiple jurisdictions, and therefore not fully subject to Maryland's sales tax. And there are states around the country that are facing similar challenges in how to source those sales as more of the economy moves to digital. So let's look at Washington. So Washington State this year also started taxing more of the digital economy. Washington's bill was Senate Bill 5814, and effective October 1, Maryland expanded its retail sales and use tax. The particular sectors of the economy that were targeted in this bill, and I'll just highlight a couple here. The first one is the tax on live presentations. That has caused a lot of confusion and consternation, especially for those offering online trainings and education, just like this one that we're all participating in today. So, if a business offers a training like this and collects a fee for that sale now, they're obligated to collect this tax and remit it. And of course, there are lots of thorny sourcing questions there about who's watching and where are they, and where is that training being delivered. So businesses that offer live presentations, including online, are really up in arms about how to apply this tax. Advertising services is another sector I'll highlight. So the tax applies to digital and non-digital advertising services. So if you're familiar with the challenges that have taken place to Maryland's digital advertising tax, this will all sound very familiar, as that disparate treatment of advertising services delivered digitally or through other media is the basis for the challenges that have been made to Maryland's advertising tax as violating the Internet Tax Freedom Act. And the Internet Tax Freedom Act prohibits discriminatory taxes on electronic commerce. So not surprisingly, litigation was expected, and Comcast very quickly filed suit back in September, arguing that the law is discriminatory and violates the Internet Tax Freedom Act. And the basis, again, is similar to Maryland. The challenge is based on the fact that Washington's law taxes most internet advertising services while exempting or excluding traditional advertising. And of course, many of these taxable services that are subject to the Washington tax affect those B2B transactions that we talked about with Maryland. Okay, so Texas also expanded its data processing tax this year, but they didn't do it through legislation. They updated their regulation on data processing. So effective April 2nd of this year, Texas updated its administrative code section 3.330, which addresses the sales and use tax treatment of data processing services. And this rule is very expansive, and it provides key definitions and lists examples that are in and out of the definition of taxable data processing. So the definition of data processing services under Texas's updated regulation is the computerized entry, retrieval, search, compilation, manipulation, or storage of data or information. And they included some examples of services that would be included, like payroll services, production of business accounting data, and word processing. And then effective October 1, marketplace provider services are included in taxable data processing services if they involve computerized entry, retrieval, search, compilation, manipulation, or storage of data or information provided by the purchaser. So these are pretty typical services that you would expect a marketplace facilitator to offer as a service to their sellers. And those are now clearly included within taxable data processing services. The interesting part about the different effective dates, the taxable data processing services was effective October 1, and that was intended to give the Texas legislature time to kind of revisit the comptroller's new reg, but the legislature did not act. So that reg went into effect, and it is currently in effect, and we'll see if it gets challenged.
So states often mimic each other's tax policies. We saw that with economic nexus, and we're seeing it now with taxing B2B services, as Argi was just explaining. So one idea that has caught on in a couple of states is the retail delivery fee. Argi, what do you think will happen with retail delivery fees in 2026? Will any cities pursue a local delivery fee, an idea that Chicago had sort of floated earlier this year?
Yeah, it's a good question. I think cities and states, too, are a little skittish when it comes to imposing retail delivery fees. Large retailers like Amazon and others have really thrown all their resources at trying to kill those bills. And for the jurisdictions that have tried it, we have Colorado and Minnesota noted on the slide. It has not gone well. Has not been a very clean implementation. They've gotten a lot of questions about who is subject to the fee, how to apply those sales thresholds, and also what products are subject to the fee. So there have been challenges in implementing these laws. But the fact is that for Minnesota and Colorado, these retail delivery fees have raised substantial revenue. I saw some estimates that Colorado had generated $93 million in fiscal year 24, and Minnesota was projected to generate 35 to, and I've seen another estimate of $55 million for its fiscal year ending in June of 25. So significant revenue generated. And as for a prediction, I think we will continue to see introductions of these types of bills because they do raise revenue and therefore they're attractive to legislators. And legislators are legitimately concerned about reductions in the fuel taxes and how to pay for roads and road maintenance. But there are far simpler ways to raise revenue than through these retail delivery fees. So I think we'll continue to see them, but I don't expect many to be enacted.
We did have a question why Colorado's retail delivery fee went down this year. And actually, Colorado is a unique state because their constitution prohibits raising taxes without a vote of the people. But their Supreme Court has allowed them to do certain fees without a vote of the people. And the Colorado retail delivery fee is really 5 separate fees. It's a fee imposed by 5 separate agencies, and they're able to change. They're allowed to change that fee in April of every year. And this year, one went up 2, one went down 1. And the result was that they actually looked at what they were spending, what they needed in the way of revenue to fund the program that this retail delivery fee was funding. And a couple of those agencies said they didn't need the amount of money. So that's why it went down. So you should expect the Colorado retail delivery fee to change every year because of the funding needs that those 5 separate agencies have.
Another common challenge that businesses face is figuring out where they are actually subject to tax in a jurisdiction and when they are obligated to collect sales tax on behalf of that jurisdiction. So this is a simple slide, but we wanted to include a reminder here that physical presence does create nexus and that nexus obligations can grow. So as a business, it's important to continue to pay attention to where are your customers, where are you making sales? because the states around the country have different thresholds, and there have been efforts to get some uniformity around those thresholds. But post, Wayfair, states started to do their own thing in establishing either dollar value or transaction thresholds that create nexus. And those are changing, right? States that passed the threshold originally are now in many states eliminating their transaction threshold while keeping their dollar value threshold in place. But these laws are changing quickly, and if you are physically present somewhere, that is going to automatically create that nexus and reporting obligation, as long as you're not like a super tiny seller. And those other economic nexus requirements are really important to pay attention to.
Argi. So, Scott, if physical nexus is still proving to be challenging for businesses, what kind of issues are arising as more businesses buy, sell, and use generative AI services?
I was actually surprised that even one state came out and made an opinion on AI. Shouldn't be surprised that it was Indiana. They don't really tax a lot of software, so they're a state that would generally not see AI as anything other than the kind of software that they don't tax. I would expect every state to tax the software. I mean, AI is software. I mean, the people that provide some sort of service to you and I through some variation of AI or providing a software service to us. It depends on how we receive it. And we're all receiving the same remotely, electronically and remotely. So therefore, the states that have used those two terms to define how they tax or how they exempt the use of software are going to come down on that answer. So South Dakota taxes all software. So they will tax generative AI. Hawaii, New Mexico, they tax it all. Iowa probably will. Indiana doesn't. Oklahoma doesn't. North Dakota doesn't. So this should follow the same pattern as most software questions. Is it taxable in the state? Is it pre-written computer software? Because that's always tangible personal property and always taxable. Is it custom software? Yeah, not really. I can't customize it. Isn't customized for me. So arguably it is pre-written computer software. At least some states will see that, and it'll be taxed in a lot of different places. But I'm surprised that Indiana was the first out of the box.
Yeah, we can debate, Scott, whether it's custom or not. I think the fact that you don't always get the same answer based on the input could throw that question. Yeah, so it's an interesting area. I think it's going to continue to evolve. But yeah, definitely interesting that Indiana was first out of the gate.
And for all you out there that are wondering whether or not you should be collecting sales tax somewhere, remember physical presence is still a thing. We talk a lot about economic nexus and how it's you need to measure where you're making sales. But if you got employees that you hire somewhere in the state that you're not collecting sales tax, you need to ask that state whether or not what that employee does in your state creates a physical obligation for you to collect their sales tax, because they will compare the withholding tax that you remit to them, to that state, for that person's income taxes with that sales tax license. So Illinois, we love Illinois at Avalara. They make things really complicated, and you may not like them. You may not like the complication. But for somebody that's in our business, they're a really good customer. So they've joined the bandwagon of eliminated the 200 transaction component of economic nexus. That goes into effect on January 1. Good share of the country now doesn't have that 200 transaction component. And like all the other states that have eliminated it, you have the ability to stop collecting sales tax if that is the reason why you were collecting sales tax in the first place. You should ask the Department of Revenue what conditions are put in on that, getting rid of your license and not collecting. But that they've stated that if you don't meet nexus, you don't have to collect. January 1, the state is repealing its 1% sales tax on groceries. That money used to go to cities. Now, in lieu of that, the state has given the cities the ability to impose their own 1% sales tax on groceries. Illinois, like most states, gives local governments once or twice a year when they can change their sales tax rate. And that's what happened here. So on January 1, there's something like 600 cities in Illinois who's going to start taxing groceries. And they had to provide notice to the Department of Revenue as before October 1 of this year. Then you may see some more that do it next year. They have to provide their notice to the Department of Revenue by April 1 of next year for a July 1 effective date. The Department of Revenue's had to change their sales tax return. The definition of groceries remains exactly the same as what it was with the state, and each local government has to use the same definition. So there shouldn't be a taxability question, but there is certainly do I now have to collect so there's 600 plus cities that have a sales tax now on groceries. That's not all of them. So now you have to pay attention to which cities haven't elected to start taxing groceries. We could have added Illinois. We could have just made Illinois a longer slide, but there are 3 states that have ongoing lawsuits associated with sourcing: Texas, Alabama, and Illinois. In Texas and Alabama, the lawsuit is an internal government thing. The cities in Texas and the cities in Alabama have sued the state over the way the state enforces sourcing. Different reasons. Texas is one of the most complicated states in the country when it comes to sourcing. Yeah, you can charge one rate if you're an out-of-state, but actually both states are. I take it back. These 2 are the most complicated states in the country on sourcing. Colorado used to be, but Colorado's getting much simpler. You can charge one rate if you're an out-of-state retailer making sales into those states. The cities in Alabama don't like the fact that you can charge one rate because that one rate is less than what would be applicable if you were collecting at each individual local government rate. And the cities are alleging that the state hasn't done a very good job of enforcing who is eligible to charge the one rate. It is supposed to be out-of-state retailers only. There's some question about whether or not that's true, at least according to the cities. Texas, on the other hand, they do their origin sourcing, and there are cities in Texas that get to, their businesses get to locate in cities in Texas and source all their Texas sales to that one location. We see this in other places. It happens in California. It happens in Tennessee. It used to happen in Illinois. And the result is that all the sales tax that gets collected from sales inside of Texas go to one city or another city instead of being dispersed like they would be if you were collecting in South Dakota or Kansas. The state of Texas, the comptroller's office, wants to change that in a way so that there aren't, you have to actually do something at the point of sale. There has to be a point of sale, which is what, if you look at the Texas law, looks like what it means. It should be a point of sale instead of just a website. Illinois is different. The lawsuits in Illinois are associated with the fact that if you are an out-of-state retailer, you have to collect sales tax everywhere you make a sale. If you're an in-state retailer, you don't. You only collect sales tax where you're located.
So Argi is going to talk about some upcoming tax amnesty programs, but Scott, can you give us a quick overview of some of the new and creative ways that states are enforcing nexus issues, sourcing issues, and complex reporting requirements?
It's relatively common. Since the Wayfair decision, there have been a lot of states that were used to be what we call origin sourcing state, where if you made a sale inside the state, you collected at that location. If you were outside the state, you didn't collect anything at all. Wayfair changed all that. Now everybody has to collect if you're out of state. And as I said earlier, Illinois made it more complicated than other states have done by requiring out-of-state retailers to collect everywhere, in-state retailers to collect only where they're located. But there are so many businesses outside of Illinois that have not completely made the transition. And there was a time when, before Wayfair, you didn't collect sales tax at all if you're outside Illinois. After Wayfair, you collected the use tax rate in Illinois, one rate if you were outside of Illinois. and now you're collecting everywhere in Illinois. A lot of people haven't made that transition yet, at least according to the state. So what they have authority now to do, they as a Department of Revenue, is to impose a 15% tax on your sales if you are not properly collecting in all the jurisdictions where you're doing business. This is an after the fact assessment. You will file a return. It'll appear to the Department of Revenue that you weren't properly collecting in all the jurisdictions where you're making sales. And they'll impose a 15% tax on you. All news. I've never heard of anything like this. Argi, have you ever heard of imposing penalty and interest on people for not doing it right is normal. A tax is a whole.
This is really punitive, and it's forcing, businesses to assign some location to all of their sales, whether it's accurate or not. So I think it's really just dangerous policy, because most businesses are trying to comply and collect the right amount of tax. So this is really punitive. So unfortunately for businesses operating in Illinois, I think it's something you have to pay attention to. So in general, I'll just give my disclaimer. Generally, I don't like amnesty programs. I think there are better and other ways for taxpayers who are out of compliance to come into compliance. Voluntary disclosure programs, offer and compromise if you have a debt that's already assessed that you can't pay. I always encourage taxpayers do not wait for an amnesty program, but there are a number of states that are still making amnesty available to certain taxpayers and tax types. So you can see them there on the screen. These are some of the newer amnesty programs that have been passed into legislation this year. We have Washington, New Hampshire, Illinois, Indiana. One note about Washington, they are offering a first of its kind tax amnesty for foreign remote sellers starting in February of next year. So Washington is really making an effort to bring some of those foreign sellers who may have nexus but are not reporting into compliance, and that's why they're doing that amnesty. And then just a quick note that Streamlined Sales Tax is working to limit the look back period for remote sellers in streamlined states and to administer an amnesty program for those sellers within their member states.
Craig, thank you for your patience. So you have been in the thick of trade and tariff changes. What's happening now?
Well, we don't have time to go into all of it. I'd invite everyone to join our Trade and Tariff Tuesdays, which we do every second Tuesday, and we go through it in a lot more detail. So we'll just kind of touch on it here. If you felt like there's been a lot of tariff increases, you are not wrong. There's been 3 million total tariff increases worldwide since January 2025 until to date. So we're not even done the year yet. So that's about a 46% increase, something like that, which is substantial. So keeping track of all of this is what we do here at Avalara. But obviously, if you're a business and trying to keep track of it becomes very daunting. In terms of economic impact, so there's tariffs on roughly 70% of imports now. So that means the Tax Foundation actually did some research and said that the current and scheduled tariffs are going to offset much of the economic benefit of the One Beautiful bill. So it remains to be seen. There's a lot of, I'm sure you've all read lots of different articles from economists that are saying it's going to have a negative drag on inflation. Obviously from the government saying it's going to boost manufacturing. And there's been, I don't think either one has been right to date. So we're going to see what happens, I guess, as we kind of go through this journey. But it is really unprecedented since the Smoot-Hawley Act in the 1930s. That's when tariffs were this high. But we really are in uncharted territories and uncharted territory in modern times. That's for sure. Some news items. Obviously, we can't cover all the different news. Again, I'd invite you to join us on our webinar where we go through this in a lot more detail. But last 2 weeks, a few things that are topical, and maybe you've read. Mexico Senate approved tariffs of up to 50% on a lot of imported goods without free trade agreements. So this is to align with North American trade policy dynamics. So you can see Mexico trying to align itself a little bit more with the U.S. policy. And then the other thing that I'm noticing, especially as sort of the U.S. tariff landscape takes shape is other countries are starting to look at how they trade with each other. I'm based in Toronto, Canada, and that's certainly very topical up here. Canadian trade deals and discussions with India and China. You can see here India and Mexico are in talks for a preferential trade deal, which would impact a lot of Indian exports. China is an interesting one because a lot of people probably would have felt that the impact on them would have been significant, but their exports have shown resilience. A lot of them are going to different countries now, especially the EU. So it'll be interesting to see how all these shifting trade flows ultimately end up. And I think that's really what we're going to see in 2026 is a lot of change in terms of trade flows and how countries negotiate with each other to minimize the impact of the U.S. tariffs. Again, topical, Costco filed a lawsuit against the U.S. government challenging the IEEPA tariffs and seeking a refund. We'll see what happens with the Supreme Court judgment, which last I read is going to be somewhere in January timeframe, maybe. So we'll see what happens with the Supreme Court. And the other big piece of news is the EU is going to end de minimis. We're expecting that to happen relatively early in 2026. The UK has followed suit, saying it's going to be, I believe they said 2028, but again, news on the ground is that they may speed that up and kind of mirror what the EU is doing. So we'll see what happens there. Here's a lot of what mixes folks up, and we get a ton of questions about this when we do our webinars, is how do all these things ultimately sort of filter through and take place? The 232 tariffs especially are very confusing for folks. Those are just, in general, the material tariffs. So that'd be copper, aluminum, steel, lumber, but especially the metals are causing a lot of consternation with folks. And actually, I just read before we started this webinar that CBP is now saying it's not just the metal content itself, but it's also the value add of manufacturing overhead, et cetera, that was associated with the metal that needs to be declared as part of the 232 tariffs. So incredibly complicated. Again, we have services that allow you to figure that out, but it has become very complicated in terms of how you figure out your underlying tariffs and how they stack up. But in general, the end of de minimis is another big news item for everyone. I'm sure everyone's aware of this. On August 29th, the de minimis exemption ended in the U.S. So that means that except for postal, so postal is a little different. Postal, it's just the IEEPA tariffs that apply to postal shipments, but anything else coming in commercially requires a 10-digit HS code. Postal is going to shift to 10-digit HS codes. It's probably going to be announced in February and implemented thereafter. But what does that mean? It means that you need to have accuracy in your tariff description. You need to have accurate HS codes. It means you need to know all the rules associated with your goods starting from value 0. So that's really, really important that you understand. I'm going to go through that in a little more detail when we get to the 4 horsemen. And I'm kind of rushing here because we're low on time, but the end of de minimis obviously is a very important development. So what did that mean? There's about 1.4 billion in de minimis shipments that entered the U.S. in 2024. It was suspended for China in May. It was suspended for the rest of the countries in August, as I mentioned. And if you look at other countries, I mentioned the EU eliminating their de minimis. Thailand just dropped theirs from 1,500 baht to 1 baht. That's like a thousandth of a cent, I think, something like that, or 1 cent. And a recent study said that, the UK, for example, could generate 1 billion by removing de minimis. So removal of de minimis, and actually what a lot of people don't realize is it was a bipartisan move because in the States, at least, there's a lot of fear that the goods coming in under de minimis were not being screened properly. So especially from China, which was sort of one of the impetuses of IEEPA, was that fentanyl precursors were coming in, et cetera. So Other countries have said similar things where really they're trying to make sure that what's coming into the country is screened properly, A, and B, that domestic retailers are on a level playing field with other with imports. Because if you look at countries like Canada, the UK, the EU are all VAT countries, meaning that, if you're buying domestically, you're going to pay value-added tax. And goods coming in under de minimis aren't being charged that tax. So that's, to the government's view, not fair to the domestic retailers. So that's what's driving a lot of that move. It's really important that you understand these 4 pieces of information for your goods, especially now that enforcement is becoming a little more stringent. The first is the de minimis exemption. We just talked about it. Every country has its own de minimis exemption. Make sure you know what the de minimis exemptions are for the countries you're shipping into. Second is country of origin. And obviously this has become very, very important because country of origin is a large determinant of what you're going to end up paying. We all know that Trump, for example, is like in the news, has placed tariffs on different countries. That's the country of origin. So, and folks get this mixed up with the country of shipment all the time. Country of origin means, in general, where the vast majority of the value of the good was added, not where it was shipped from, but where the value was created. So make sure you know your country of origin. Third, and probably most important, is your tariff code. You can think of a tariff code as a numeric description of a good. Every country in the world is common up to 6 digits. However, every country in the world also appends between 3 and 6 more digits. So it becomes very, very complex to understand what is typically a 10-digit code. And just so everyone understands how duty rates work, except for postal in the United States, tariff codes are, think of it as like an Excel table. The tariff codes would be the rows describing the goods. The country of origin would be the columns. The intersection of those two things is the duty rate. So that's why it's so very important that you understand the country of origin and the tariff code. And then, of course, the declared value is the value that is going to be multiplied by that duty rate. So you need to know your declared value as well. And sometimes it could be, there's different rules around declared value, but you need to understand what applies to your goods. So make sure you understand your declared values. What are we seeing in terms of, obviously there's been a lot of changes in how folks think about inventory and supply chain. In the past, there used to be a lot of publicity around just in time, for example. I think that's changed pretty dramatically from just in time to resilience. So, exploring diversification of your shipping carriers or sources of supply, that's been a common theme. Automating using global trade compliance tools such as ours, where you can make sure that the 4 horsemen we just talked about, you make sure that you have your data correct. Working with a customs broker and leaning on their network and expertise is another common strategy. However, I would caution everyone that the customs brokers, particularly in the United States, are very, very busy and overwhelmed. So you may not get fast answers. Make sure your product details are compliant with global trade regulations. These are the 4 horsemen. Make sure your data is correct. And then the other strategy we've seen is to build inventory to absorb some of those short-term headwinds. We saw that a lot with the changes in China when there was an announcement. It didn't go into place right away. A lot of goods came in just to get ready for that. That's another strategy that we have seen.
Thank you very much, Craig. We appreciate it. Yeah, we are out of time for today. That concludes today's session, but I do want to say thank you so much to our presenters today.
Well, everybody, that's a wrap on episode 5, and what a way to start out 2026. The tax landscape is more complex than ever, but you don't have to navigate it alone.
From sourcing lawsuits to expanding digital tax laws and new trade dynamics, this year is going to keep finance and compliance teams on their toes.
Big thanks to our expert panel, Gail, Scott, Argi, and Craig, for breaking down what's new and what to watch.
And look, if you want to read the full Avalara Tax Changes 2026 report, check the show notes. It's packed with even more insights.
And as always, everybody, don't forget to follow or subscribe to the Beyond Death and Taxes podcast so you don't miss an episode. We've got a great season ahead for everybody.
Thanks for starting your year with us. We'll see you next time.